Welcome to the Allan Small Financial Show. As always, I want to thank everyone for taking the time out of your busy day to spend it with us. I think we have a fantastic show today. It's always exciting when we do a show right before a central bank has their meeting, especially when it's the Federal Reserve. The Federal Reserve is going to have an announcement and then take some questions in and around 2 o'clock this afternoon, a couple hours from now. So it's always exciting to hear what their new interest rate policy will be and what they have to say. This week's show, however, I really wanted to hone in on some of the questions and topics that I've been hearing from individual investors. And I think we've done a great job in doing that. So let's see what the topics are for today. Who's controlling the markets? Is it the bears or the bearish thinkers? We're going to talk about the bear case, the bearish case for the markets, and why individual investors might be a little bit nervous at this time. We're then going to move over to the other side, the glass half full side of things. Who's controlling the markets? Is it the bulls? Are the bulls, or do the bulls have a case in being bullish right now? As usual, we'll go through our This Week segment, where I talk about what I believe is important for individual investors to consider when they make their investment decisions over the next few weeks. Should you sell in May and go away? That's a saying I think many investors are familiar with. Every time, or every May, we always hear this saying: should investors sell their investments, move into cash, go off for their summer vacations to their cottages or their summer homes, and then come back in the fall and reinvest? Is that a good investment strategy? The third U.S. regional bank has now failed. The regional bank is called First Republic. First Republic was actually bigger than Signature Bank and Silicon Valley Bank. What happened to the bank and what happened with their assets? We'll talk a bit about that as well. The IMF, International Monetary Fund, they project that Canada will have the second highest GDP or growth rate out of all G7 countries. Pretty good, but still, when we delve into it a little more, you'll see that our growth rate is actually slowing significantly, even though it could be the second highest over the next few years. U.S. debt ceiling debates and issues. What's happening there? We're hearing more and more about the U.S. Can they default? Will they default on their debt obligations? Not a good thing. We saw this back in 2011. Wasn't a good thing for the U.S. They got their credit rating dropped from a AAA to a AA. So we'll speak a bit about that. Converting RSPs to RIFs, something that I get questioned about quite often. People are wondering, do I need to do anything when I convert my RSP to a RIF? At what point does it have to be done? At what age? Could it be done at any point in time? So we'll touch a bit upon that. And I guess lastly, before we get into your questions, I wanted to talk about Tesla. Tesla has probably been the #1 stock that I've been asked about for the last month or two. What's going on with Tesla? Why has their share value fallen as much as it has? What's going on with Tesla as a company? So we'll touch on that. We'll try and get into whether Tesla is a good buy opportunity today or maybe still a do not touch. So let's get on with the show. So are the bears or the bearish thinkers controlling this market? If I spoke to someone who looks at things, the glass half empty versus half full, I think they would tell you that yes, the bearish sentiment is controlling this market. We're seeing interest rates go up 9 times in the past year, and as of 2 p.m. this afternoon, it'd probably be a 10th time. We're seeing a slowdown right across the board in all sectors of the economy. When you listen to CEOs of large corporations in the United States and Canada, and really right across the world, they all say the same thing. Business is going well or okay, but it's definitely slowing. And when you look at business slowing, and we've talked about this in previous shows, when you look at the earnings of these businesses, let's say all the businesses that trade or make up the S&P 500, and then you put a multiple on those businesses, let's say 7 or 18 times earnings, which is your premium as we call it, you end up getting an S&P 500 number of in and around 4,000. Well, as I've said in previous shows, the S&P is trading at 4,100 right now. So at best, maybe the S&P is at fair value or maybe even overvalued. So that's what the bears are going to tell you. Lastly, and most recently, the financial crisis in the US. Seeing these regional banks fail, we've now seen 3 of them fail, and we'll speak about First Republic a little later in the show. But with the banking crisis, or mini crisis, if you want to call it that, in the US, we're seeing credit dry up. These banking institutions, the ones that are left, the regional banks that are still doing very well, they look out and they say, okay, well, maybe we're going to have some new rules coming down on us that will prevent these banks from lending as much as they have. The banks themselves, they don't want to lend as much because they want to keep as much of their assets or cash on hand. Because if we do see a continued run on the banks, if people continue to take their money out of the banks because they can get a higher interest rate on a government bond or a money market fund or a GIC, for example, banks want to have cash, or at least more cash on hand in case they need to tap into it. So banks aren't as quick to lend. We say credit is starting to dry up. And we know that regional banks make up more than 50% of the loans to small businesses in the US. And we know small businesses in the US and Canada, that's what really drives our economy. So if we have a slowing economy, we have credit drying up where banks aren't as willing to lend, how are things going to move forward? How can the stock market move forward? And here you have a few charts we have. One of them, again, we've seen before. This is the Fed funds target rate. You can see how much it's gone up, showing that higher interest rates causing overall slowdown in the economy, causing a slowdown with the banks even, because as I said, if you can get a higher interest rate now on a government bond because interest rates have gone up so much, that's not going to be a good thing for the banks. Once upon a time, we thought higher interest rates is good for banks because they would make more on the loans that they provide. But I guess everything in moderation, right? If they're having to fight back all the people that are pulling money out because they can get higher interest somewhere else, then it's not necessarily a good thing. So everything in moderation, everything in a balance always is best. A second chart we have here actually is one on retail sales in the US. We can see how much retail sales is starting to moderate now. Retail sales has been very, very good. It still is very good, but definitely starting to come down. So wherever you seem to look right now, the bears seem to think that they have things under control, that shorting the market, as we've heard in the past, might be a good idea. Betting on the market coming down, stock market falling, investments falling, might be an idea for a lot of investors. I don't think it is. And we're now going to move over to the bull case. So now let's get into the bull case. I love the picture of there, that the bull. You know, I can't help but always think when I see a picture like this, going to Wall Street in New York, they have a nice big bull on the street. It always a great thing, a great place to take a picture. So I always think of that. But the bull case is where I am, actually. I always like to look at the glass half full. For many of you that know me well, you know, I at times I'm cautious, but when there are issues or blood in the street, as they like to say, that's always a good time to upgrade your portfolio, to look for good quality investments. I'm going to take the bull case here. And one of the reasons why I'm going to take the bull case, or why I think the bulls or the bullish people are in control, is unemployment. We still have record unemployment, the lowest unemployment rate really that we've seen ever in our country, in Canada, and in the US. So when people are working, earning a paycheck, have money to spend and pay the bills, even though our bills have gone up because of inflation and interest rates have gone up, which makes carrying debt a little bit more challenging, if we have a job and if that job is paying us and our wages are rising, that is a good thing. And it allows us to be able to do the things we need to do to pay our bills and to go on trips and to buy clothes or big ticket items at the store. A bullish, I guess, sentiment that I have here, a chart here, is the JOLTS. Let's go with the JOLTS one first. As you can see, JOLTS stands for job openings and labor turnover. You can see that the actual chart is coming down. Now, for quite some time, we actually in the United States saw practically 2 job openings for every person looking for a job. And the Federal Reserve did not like that, because that meant that if you were in a current job and weren't making a lot of money or didn't like what you were getting paid, you could switch jobs and demand higher pay because companies were looking for workers. They were dying to find workers. They couldn't find enough workers. Well, what we're seeing now is the job openings is starting to come down. At one point, it was 11 million job openings in the United States. Now we're under 10 million, 9.5 million. Still a big number, but definitely moving in the right direction. As I mentioned earlier, let's go to the unemployment chart here. You can see that unemployment spiked up, a few years ago. And now you can see how much it's come down. And when you look at unemployment right now, March of 2023 in the United States, it's somewhere around 3.5%, somewhere around 5% here in our country. But you can see that spike happened during COVID, of course, when people were temporarily laid off and everything was closed. But take away the COVID and the job situation, jobs numbers in the U.S. look fantastic. So the bulls are in my opinion, are in charge. Lastly, I want to talk about interest rates. Today, we're going to hear a 1/4 point hike from the Fed, but I believe this could be the last interest rate hike in the United States. We've already seen a pause here in Canada. So obviously, we are a lot closer to the interest rate hiking cycle being over than the beginning. I think that's a positive. Even if interest rates stay high for a long period of time and don't fall as they're predicted to fall over the next year or so, I think this market can continue to move higher. I don't necessarily believe that we need lower rates for this market to move higher. We just need some stability. We need to understand where rates are going to be, and we need to figure out, okay, if interest rates are 5% in the US and 4.5% here in our country, I think the market will be able to gain some traction, understanding that this is as high as it's going to get, and it's perhaps at some point going to go lower, but at least in the meantime, businesses can account for it. Banks, more importantly, can account for these higher rates and learn to deal with it over time. So in my opinion, with rate cycle or the higher interest rate cycle coming to an end, with jobs still fantastic job growth, not as high maybe as it was a few months ago, but still we're seeing good job growth, unemployment rates at record lows. We're seeing job openings starting to come down. We're actually seeing 80% of businesses this past quarter beat expectations. That's another positive. And we'll get to quarterly earnings in the next segment. But we're seeing businesses beat the expectations. I'll be lowered expectations, but businesses are still doing better than expected. So I would say that, in my opinion, the bulls have things under control. So depending on how you want to look at things, whether it's the bullish or the bearish way, I've given you many ideas as to how to look at the current economic environment. But again, I think it's always good for investors to keep that glass half full and not half empty. So this is the part of the show where I discuss what I believe is important for individual investors to consider before you make your investment decisions over the next few weeks. As I always do, here are my 3 points for this show. As you can see, Fed speak and economic data always on my list. Can't help but to look at what the Federal Reserve is saying, what the Fed governors say in between their meetings. They really move markets to the upside and to the downside, unfortunately. And they base what they say on the economic data, at least so we hope, whether it's jobs numbers or whether it's CPI or inflation, whether it's core inflation, when you strip out volatile energy and food prices, whatever they're looking at, it is important for them before they make their interest rate policy decision. I think you also want to look at quarterly earnings. I touched on that in the segment prior to this. We're in the, kind of maybe halfway through, maybe 2/3 of the way through quarterly earnings. We're going to get a lot more quarterly earnings over the next few weeks. What are companies saying? As I mentioned, 80% are beating expectations in the US. We're just starting to get quarterly earnings here in Canada. Rogers, as an example, had fantastic earnings, I believe about a week or so ago. And lastly, never go wrong taking a profit. What does that mean? Well, I think sometimes taking a profit, taking some money off the table is a good idea. So we'll touch on that and why you should be considering that before you make your investment decisions. So let's move forward with our first point, Fed speak and economic data. As mentioned, the Federal Reserve will make an announcement at 2 p.m. this afternoon, and it is highly likely that they're going to raise a quarter basis point, so another 25 basis points. We have a chart here of the Federal Reserve interest rate hikes, all the 9 hikes that we've seen over the past, I guess, year or so. You can probably add another column here pretty soon. That will be the 10th one, and it'll be 25 basis points hike. When you look at, we'll go to the next chart. We've seen this chart before, comparing the core inflation rate in the United States, the overall inflation rate of about 5%, core inflation 5.6%, so a little bit higher, even if you were to strip out the volatile energy and food prices. Interesting enough, when the Fed raises a quarter point, their interest rates are going to be 5.25. We know overall inflation is now 5, so now the bank rate, central bank rate, is now going to be higher than the inflation rate, which to me signals that we could see a pause. Not only could we see a pause, but obviously the banking turmoil in the US is really putting pressure on the Fed. What is the Federal Reserve going to say? How are they going to react? What indications or what hints are they going to give to us? As you know, we parse through everything that every word that the Fed is going to say. He'll have his, Jerome Powell, the head of the Federal Reserve, will have his press conference in and around 2:30 p.m. And what are they going to tell us that is different than the last meeting? Keep in mind, we have a jobs number in the US and Canada coming out this Friday. We have inflation data coming out next week, a week today, actually. So we'll see what the Fed says. They may say pause. They may raise 25 basis points and then say or hint that they may pause. I think that's the likelier scenario. So as an investor, I think the 2 o'clock meeting, the 2 o'clock announcement, the 2:30 press conference is very important for individual investors to consider before you make your investment decisions. Second point I wanted to discuss, the quarterly earnings. And this quarterly earnings season, I think, has been fantastic. Yes, the bar has been set extremely low coming into this quarterly earnings season. Many investors expecting these businesses in the US and Canada, to tell us that things are continuing to slow. In my opinion, we've had a handful of really, really good earnings, and we've had many other earnings reports that were pretty good. Wanted to highlight a few earnings that I thought were pretty good. One of them was Microsoft. And we have a chart on Microsoft, and you can see how much Microsoft has actually gone up on the far right of the chart. This stock, I would say a month ago or so, was in the mid 200s, 250, 270, now well over 300. It's had a tremendous run. Talks a lot about, Microsoft spoke on the call or on their press conference or their call with journalists. They said that they're seeing a lot of gains in the artificial intelligence area. Their Azure or their cloud business, even though business is slowing down, still pretty good. LinkedIn from social media, you have Xbox for gaming. They're pretty much every hot area of the market that you want to be in, not to mention their teams and their software, Windows, etc. So Microsoft is in a sweet spot, and they continue to outperform quarter after quarter. Another name that did really, really well, a name that probably was hit the hardest over the past year, and that is Facebook, or what we now call Meta, parent company of Facebook. As you can see here, if you bought Meta somewhere around November of last year, what a ride you would have been on. Again, Meta, Microsoft, obviously, if you're going to take a look at these companies and consider owning them for your portfolio, you have to make sure that the risk tolerance, or you have the risk tolerance or correct risk tolerance to buy an investment like this, because they can be quite volatile. But I just wanted to highlight Meta, another fantastic earnings report. 2 to 3 billion people use Meta's apps or on Meta apps every day, which is a huge thing, very powerful. Their reels, their stories, just really catching fire. And they're in competition with TikTok. Obviously, with the name now Meta, they're still putting a lot of money towards the metaverse and what that brings in the future. We had Lauren Sugarman last show talk to all of us about the metaverse. So hopefully those that tuned in know a lot about the metaverse. So keeping, I guess, an eye on names like these, quarterly earnings like these is very important. Lastly, I have a chart on Caterpillar. Again, beat on the top line, beat on the bottom line. But as you can see here, Caterpillar, which is a company that sells heavy machinery globally, a global company, versus United Rentals, which is rents heavy machinery, but mostly in North America. Caterpillar didn't do so well after they reported earnings, even though earnings were good. So maybe Caterpillar is a name trading, I think, somewhere around 12 times earnings, so fairly cheap. Maybe Caterpillar is a name that individual investors want to take a look at. So keeping an eye on quarterly earnings on this quarterly earnings season is really important before you make your investment decisions. I think I have one more here. Bank of America, another opportunity to pick up one of the largest banks in the United States and the world. Again, good earnings, solid earnings. They actually set aside less money for bad debts than they did the quarter before, even though things continue to slow down. Yet the stock, even though you can see here on the far right, kind of blipped up, it has pulled back down below $30 a share again. And may I remind you, this stock used to be almost or in and around a $50 stock once upon a time. So down quite a bit from its previous highs. So let's go to the third point that I wanted to discuss, which is before you make your investment decisions, perhaps you should consider taking some money off the table. You never can go wrong taking profit. And I think when I look at individual investors' portfolios, what I tend to look at is, why would I take a profit? Well, I think I would take a profit, either all or sell the whole investment or take partial profit if an investment was starting to get pricey. Or perhaps I was starting to hear some negative sentiment or negative commentary coming from the company, coming from its CEO. Or maybe it's just a matter of taking some profit because there's another opportunity somewhere else and to generate some cash in a portfolio. So there are many reasons why someone could take a profit or take profit off the table. And whether you take the whole, sell the whole investment or partial, I always, if I can, like to trim as a stock moves higher. So I have a couple of stocks here, for example. One is Broadcom, a chip maker in the US. You can see how well this stock has done. I think Broadcom can actually go even higher. But yet I've been trimming it as the stock moves higher. Because if we are wrong and that stock were to pull back, at least we could say we took a lot of profit when things were good. If the stock keeps running higher, well, we just keep trimming more and more profits, taking more profits off the table. So a very good strategy, a strategy that is almost a win-win kind of situation. The other chart I have in this spot is, again, Meta. Meta is another name I started to take some profits on because I believe the stock has run out from $80s, $90 to well over $200. Even though investors or analysts think this stock can go over $300, I continue to trim and take some profit off the table because I think it's prudent. What happens if Meta should stumble? The metaverse should stumble and be delayed. Would Meta or Facebook pull back maybe under 200 again? So if I can take some profit at 240, I think that's a very good strategy. So before individual investors make your investment decisions over the next few weeks, if you're sitting on a bunch of winners like a Meta, like a Broadcom, or perhaps some other stock, maybe it's a good idea to start trimming some of those profits, generate some cash, either reallocate that cash somewhere else, or let it sit in cash for a little while, making 4.5% until you come up with another investment idea. Because I think when you trim profits, you can never go wrong. So as the saying goes, sell in May and go away. Should you be doing that? Well, we all know that the period of time between May and let's say October tends to underperform the time period between October and May. And it does by quite a bit. And I always get this question asked of me every spring, every May, June. Allan, should I just sell my investments, sit in cash, go off to my cottage, and then worry about things in September, October when I come back, when the kids start school and the new year begins? And I say, well, you can do that, but I don't think it's the right approach. There have been many years where the markets over the summer have actually outperformed. And then unfortunately, towards the end of the year, we saw a bit of a sell-off. We saw a bit of a sell-off at the end of last year, heading into January. And so for me, I don't think it's as simple as sell in May and go away. I think you want to be invested. You want to own good quality investments. And if you are going to your cottages or summer homes or on vacation, hopefully you have an investment advisor to keep an eye on things for you that can advise you even while you're away in case you need to make a decision. And yes, it is true that the volumes of trades on the New York Stock Exchange, on the Toronto Stock Exchange, definitely dip, especially as we get on into the summer. By the third or fourth week of August, you're looking at the lowest trading volumes of the year. And of course, if something negative happens, the markets can really move on that news because the volumes are so low. So yes, things can be volatile. Yes, the market doesn't have a lot of traders there, doesn't have a lot of money going in and out. But at the end of the day, in my opinion, you still want to own good quality, regardless of what time you're looking at things, regardless of what month of the year. So the sell in May and go away to me has never been something that I practice. Even though investors may get nervous if they're traveling or if they know this time of year can be a little more volatile because there's not a lot of trades going on, I think you still want to stick with the good quality investments because no matter what type of environment, those good quality investments will always rise to the top. So we just saw the third bank in the United States fail, First Republic Bank. And there was a deal brokered by the FDIC for First Republic to sell its assets to JP Morgan, the largest bank in the United States. And the reason for that is when First Republic reported earnings this past few weeks, I think it was about a few weeks ago now, they reported that they lost upwards of $100 billion of deposits, of money leaving the bank during the banking crisis in March. And if there wasn't a run on the bank before that, once that news came out, there was even a greater run on the bank. And you can see here, we actually have a chart of First Republic, and you can actually see what happened to the bank stock. It really tanked. It was well over $100 a share, and now $3, and today it's worth nothing. And it's unfortunate because in today's age, you can move money from one bank to another or take money out of a bank by hitting a button. Back in the day, you actually had to go to your bank and take money out. Today, online banking, money moves so quickly. And that's really what happened with First Republic. Again, when you understand why First Republic, Signature Bank in the US, and Silicon Valley Bank, why they had their issues, you understand what happened. You understand that money left the bank to find higher interest rates elsewhere. And the banks can't just increase the interest rates that they pay on their savings accounts, because if they pay too much, that eats into their bottom line. The banks need to make money. They need to make money on the spread between what they lend money at and what they pay interest on for the money that they have in their accounts, to your GICs, et cetera. So if they're paying you 5% and they're only charging you a 6% loan, let's say, they're making now 1%. Whereas if they charge a loan of 6 and they pay you 3, they're now making 3%. So a lot of money has left the banks in search for higher yield, and First Republic was no different. The good news is, in my opinion, all the assets or all the deposits are now safe under the arm or the wing of JP Morgan. So JP Morgan now runs the assets and owns those assets, or at least has the assets with them for individual investors. I thought one chart I wanted to show, which is really interesting, We just showed the First Republic, but this is a chart about US bank failures by year adjusted for inflation. And it's quite interesting. If you look at Signature Bank in New York, 110 billion, Silicon Valley Bank, 209 billion, First Republic at one point was $213 billion. Compare that to what happened in 2008, where you had Washington Mutual, the biggest bank failure in history of the United States, 430 billion, and then 24 other banks failed worth 94 billion. These three banks that failed recently are worth more than the banks that failed or were bigger than the 25 banks that failed in 2008. So you can see the magnitude of what's going on. And I'm hopeful that the Fed is watching this, because if they are, the hope is that they're not going to raise interest rates, or at least if they're going to raise interest rates today, they'll put a pause right after. So the third bank failure has been one that might have been expected. We knew First Republic was under the gun. The problem I see is that the underlying issue is still there. Higher interest rates moving higher, possibly again today. That problem still exists for the banks. The problem of individuals taking out their deposits, their money from savings accounts, checking accounts, wherever they have their money, and moving into other areas. So the underlying problem, unfortunately, is still there. Hopefully, the government will continue to backstop these deposits, maybe even increase what they guarantee. In the US, it's 250,000. In Canada, it's 100,000. They can increase that. Hopefully, money will feel comfortable remaining in these regional banks, and we don't see a fourth regional bank failure. But for now, it's quite interesting what's happening in the US. And as I said on another show and my radio show, that I don't believe this can come up to Canada. Our banks are very large. Our bank deposits are very sticky, a lot more sticky in the US. We only have a handful of banks that control most of the assets, 80% of the deposits in our country. So what's going on in the US is just because their banks there are many more of them than we have up here. We only have less than 100. So don't think that what I'm saying about the US regional banks is the same for us up here. So going forward, let's see what the Fed says, and hopefully we can get some stability with these regional banks. So the IMF has said recently that they expect Canada to have the second highest growth rate for 2023, just behind the United States, and the second highest growth rate in 2024. And I believe we have a chart that shows this. In 2024, I think they anticipate Spain to be a little bit higher than us. But you can clearly see that growth is starting to slow. So the fact that we're the second highest out of the G7 countries, I should say, is good, but our growth is still slowing. GDP or growth is still slowing. We are somewhere around, let's say, for the first quarter of this year, in that 2% rate. But if we extrapolate that, and if the IMF is saying a 1.5% rate for 2023, that means the rest of this year will either be flat or maybe even negative. And that's why the talk about a recession has come about, because the start of the year has looked really good. And if by the end of the year, we're only growing by 1.5%, that means that quarters 2, 3, and 4 must be less than the 2.5% rate that we believe we're growing at right now. So keep in mind as we move forward that the slowdown is happening. It's going to happen. It is already happening. Bank of Canada has told us to expect it. Federal Reserve in the US recently has said that you could see a mild recession in the US. Again, they believe that inflation is more important. The fight against inflation is more important. That if we do see a mild recession in the US, or if there's a mild recession in Canada, yes, that's not good, but we can handle it versus keeping inflation as high as it's been. So even though we're looking at GDP growth in this chart as second best in G7, all the G7 nations, understand the main point is growth is slowing. And you don't have to look far. All you got to do is listen to some of these CEOs talk about their businesses, whether it's in tech or bank, or whether it's in retail, or whether it's in anywhere, pharma. and businesses are definitely slowing. So good news, second highest in the G7, but not so good news, understanding that our growth rate will slow for the remainder of this year. So we're hearing a lot more and more about the US debt ceiling debate. And this is a debate that's going on in the US within their government. And what the US debt ceiling debate is all about is the US being able to pay their bills. Just like any one of us, right? We need to pay our bills so that we can continue to have the services or the goods that we need to survive and thrive. The US is no different. They have bills that they need to pay. They have people that have borrowed money, or they have borrowed money from, I should say, not they have borrowed money, but they have borrowed money from countries like China, Japan, and many others that they need to continue to pay interest on their borrowings. If the United States does not increase what we call their debt levels, then they won't have the money to be able to pay interest to the people that they borrowed money from. They also have to pay government workers, and many other bills that they need to pay. Interesting chart we have on this. If anybody wants to know what the government of the United States is in debt right now for, well, you're looking at about 30 trillion. That number has moved up significantly over the past, let's call it 20 years. Really started to move higher in 2010, as you can see, over the last 10, 12 years. And so you have the Republican side of things. They're saying they will increase the debt limits so that the United States can continue to pay its bills, but they want the spending to slow down. The Democrats are saying, well, we need to continue to spend to survive and thrive, and you can't hold us hostage. This is the President of the United States saying this, can't hold us hostage because you're increasing the debt levels so that we can pay debt that we've already spent that money. This is debt this is money we've already spent. So we need to increase these levels so that we could continue to spend the money. So there's this debate going back and forth. One side wants to have the flexibility. The other side wants to limit how much they can spend. And this can become a real problem. As of June 1st, the United States is going to be bumping up against their debt limits, which means they won't have the money to pay their debt. We saw in 2011, when they came up against this level, the U.S. lost their AAA credit rating. And we don't want to see the U.S. lose their credit rating. Some people actually predict that you could see the stock market fall perhaps as much as 10% if the U.S. defaults or comes close to defaulting on their debts. So keep an eye on the negotiations out of Washington. We're starting to hear that they're negotiating harder and more frequently now, which is a good thing. Hopefully they'll come to some resolution. Many people think they're just going to kick the can down the road, as they always do, maybe to the end of the year or into early next year. But we need a resolution to this issue, because if the U.S. does not pay their debt, this will spill over into the stock market, and a lot of other problems will arise because of it. Converting RSPs to RIFs. A lot of people ask me, Allan, what does that mean? What do I have to do? The quick answer is not much. Just got to sign a form to open up a RIF account. The RIF stands for Registered Income Fund. RSP, as you all know, Registered Retirement Savings Plan. When you reach the age of 71, the government forces you to convert your RSP to a RIF, so that at age 72, or the year you turn 72, you start to withdraw a minimum amount from that RIF, or from the matured RSP, whichever way you want to look at it. But in terms of the holdings in an RSP versus a RIF, it all comes down to the person themselves. Do you still want your money to grow? Or can you now just buy income generating investments? A lot of people still need their money to grow, so they stay the course. They may be in growth investments in the RSP, and they remain in growth investments in the RIF account. And then out of the gains of the portfolio, that's what they draw on to pay them that minimum amount that they need to take out every year. Some other clients convert some of their investments to interest paying investments, some dividend payers, so that they can generate income or cash inside the RIF so that they use that to pay them their monthly amounts. Some people do a monthly amount, some people can do an annual, one lump sum amount a year, quarterly. It all depends again on the individual investor. So converting RSPs to RIFs was a question I get quite often recently. And I just wanted to highlight that there's not a lot of change that needs to be done. It all will depend on the person themselves, what your investment objectives are, how much money you need to pull out of your account, and if you're comfortable with the way the account is currently. One of the hottest stocks we seem to talk about is Tesla. And got a lot of questions about Tesla. And again, as I said off the top of the show, I always like to address some of the questions, or as many questions as I can, during the course of the 2 weeks from show to show. Tesla's a stock, as you can see, we'll pull up a chart here, has fallen by about half since the highs that we saw back a few years ago, well over $300 a share. Now it's about 160. The number one problem with Tesla right now, as I see it, is that they're cutting prices on their vehicles. Now, if you're looking to buy a vehicle, a Tesla, it's a good thing. But if you're a shareholder, that means that profitability is falling. The costs of building a Tesla or a car are not dropping. They're staying the same or going higher. And if you're now selling a Tesla vehicle for less than you were before, your profits are falling. And that's what we're seeing with Tesla. Now, Tesla is one of the few, or I think the only car company that actually is profitable with their electric vehicles. Some of the legacy car companies, GM and Ford, are still losing money on these electric vehicles. So that's a positive. But Elon Musk, CEO, and Tesla in general, they've made a conscious effort, and their approach is they want market share. So to gain market share, they're going to cut prices, make their cars more affordable so that the average person can buy a Tesla and see more and more Teslas on the road. Now, keep in mind, GM used to have this philosophy many years ago. They used to lose money on all cars they made, but they had the biggest market share. They were the most dominant market share out there. So what did GM do over the last 5-10 years? Reduce the amount of cars they were selling. So they weren't number one any longer. And they wanted to make more profitable cars, more expensive cars. So they didn't care about market share. My guess is that at some point, Tesla will do that as well. Stop trying to be the dominant player. Over time, more and more car companies will have electric vehicles, more and more electric vehicles. It's only a matter of time before their market share continues to dwindle. Used to be almost 100%. Now it's 60, 70%. I wouldn't be surprised to see it 40, 50% over the next few years. So as an investor, understand their market share will get less and less, but I think they need to keep the price of their vehicles high. I think they need to be profitable and remain profitable. So if Elon Musk is listening, I think cutting the prices of your vehicles may be in the short term a good thing to do, but over the long term, not a good thing to do. And as you can see by the chart and the stock price that we've shown, investors will agree that Tesla may not be the stock to own if profitability continues to fall. So this is the part of the show where I like to get into some questions that I've received from individuals during the course of the show and questions that I've received over the past couple of weeks. Now, the show has gone a little longer, so I only have really time for one question, and hopefully I'll be able to get to some of your questions next show. But the one question I think I'll answer for today is, what services do you provide as an investment advisor? And I think that's a pretty good question to answer and end the show on. And really, for me, I advise on pretty much all types of investments. I don't do options. Options is not something I'm licensed for, and something that really not many individual investors ask me about. But other than that, I can help you in many different areas regarding money management, building portfolios, retirement planning, estate planning, you name it. When it comes to money, as I tell my clients, please give me a call if you have any questions, something you saw in the stock market, something to do with your portfolio, something you heard, saw on the news, read online about. All these things I get asked about on a regular basis. And this is what makes up the content for our show. So if you're someone out there that is watching today and not sure whether I can help you or whether your question that you may have is good to ask me or makes sense to ask me, send me a message, give me a call, ask it. You'd be surprised. I tend to delve into many different things regarding money, and I'm sure I can help you. So with that, I'm going to close the show and say thank you again for everybody for watching, for spending some time out of your busy day to be with us. Our next show will be 2 weeks from today. I believe that is Wednesday, May 17th at 12 noon. And until then, happy investing.